All right, let's talk about advanced drainage systems, ticker WMS. They're a big player in water management, and man, did they just drop a quarterly report that really made the market sit up and pay attention. And when I say pay attention, I mean it. The stock just popped, jumping nearly 9% on some pretty heavy trading volume. So you gotta ask, right? What exactly was in that report that got everyone so excited? So here's how we're gonna break it all down. First, we'll hit the headline numbers. Spoiler, they were great. Then we'll dig into the real magic, the margin story. After that, we'll talk about a huge acquisition that's a total game changer. We'll also get into what management's been saying versus what they're actually doing. And we'll wrap it all up with our take on the stock, the next call. Okay, first up, the headline beat. You listen to the earnings call and you hear management talk about a choppy market, a challenging environment. But then you look at the numbers they put up, yeah, that tells a completely different story, a much, much better one. And wow, just look at this. The revenue came in at over $850 million bucks, when Wall Street was only expecting around $802 million. That's a huge beat. But the real knockout punch? The bottom line. Adjusted earnings per share hit almost $2. The street was hoping for maybe $1.70 tops. So we're talking a beat of more than 15%. That's not just a little better than expected. That's a statement. So a big top-line number is great. Don't get me wrong. But if you really want to know if a company's firing on all cylinders, you have to look at the margins. And for WMS, this is where the story goes from good to great. This is how they pulled off that massive earnings beat. Okay, check this out. This chart right here is the engine room of that earnings beat. Their adjusted EBITDA margin jumped to almost 34%. Now that's up from about 32% last year. That 2 percentage point leap, or 200 basis points if you're keeping score, is absolutely massive in a business like this. That's what really lit a fire under their profits. So you're probably asking, how'd they do it? Well, it wasn't just one thing, it was a really smart combination. First, they did a great job managing the spread between what they pay for materials and what they charge for their products. But the real kicker, and this is so important, was a shift in what they were selling. Their super high margin Infiltrator business, revenue there was up a wild 25%, and their allied products line was up 13%. Long story short, they sold way more of their most profitable items, and it absolutely paid off. And this isn't just about one good quarter. The cash they're generating, the momentum they have, they're putting it to work. They are making a massive strategic move that is going to fundamentally change this company. And that move is the acquisition of NDS. And when I say massive, I mean it. We're talking about a $1 billion all-cash deal to buy NDS from Norma Group. This isn't some little tuck-in acquisition. This is a huge company-defining bet that's meant to put their growth strategy into overdrive. So why drop $1 billion on this? Well, the thinking here is pretty straightforward. 1, it gets them into new markets, like retail and landscaping. 2, they get a bunch of new products that fit perfectly with what they already sell. 3, they think they can squeeze out over $25 million bucks a year in cost savings. And maybe the best part for shareholders? They expect this deal to boost their earnings per share right out of the gate in year 1. Okay, so you've got a fantastic quarter, you've got this huge new acquisition. You'd think management would be doing a victory lap on the earnings call, right? But no. And this is where things get really interesting. Their tone was, well, it was surprisingly cautious. And I think that was very deliberate. Yeah, listen to this from the CEO, Scott Barber. He's talking about being cautious conservative and how the back half of their fiscal year is always the most uncertain. He's basically telling everyone, hey, pump the brakes, don't get too excited about these amazing results. He's trying to manage expectations, for sure. But, and this is a huge but, you have to look past the words and see the actions. Because while they were talking all cautious, they went and raised their guidance for the entire year. And not by a little bit. They bumped up their sales forecast and jacked up their EBITDA guidance by a whopping $45 million bucks at the midpoint. This is a classic case of under-promise and over-deliver if I've ever seen one. All right, so let's tie this all together. You've got an amazing quarter, a game-changing acquisition, and a management team that's talking cautiously while raising the bar. What does it all mean for the stock going forward? It's time for the next call. When you look at it, the story from here has two sides, right? The bull case is all about those margins staying strong, the NDS deal working out great, and them continuing to grab market share. The bear case? That's about worries over raw material prices, a big slowdown in construction, and, maybe that cautious talk from management actually turns out to be true.
For us, after looking at everything, the amazing quarter, the big acquisition, the watch what we do, not what we say guidance, the bull case just feels a lot stronger. So our rating on WMS is outperform.
And here's why. We think WMS is doing something really important here. They're changing from just a pipe company into a full-on water infrastructure platform. That margin growth, we don't think it's a fluke. We think it's here to stay. And that NDS deal is only going to pour gasoline on the fire. We believe that cautious guidance is just them setting a low bar they can easily jump over next quarter. Our call, we think the stock retests those highs above $150. And just a reminder, this is not financial advice.